I have to say it is really thrilling, actually, to be back together with our annual conference. So thank you very much for coming out today. So we're going to talk about sustainable materials, myself and my colleague Claire Jervis, who's a senior analyst on our investment team. And then we're going to hand over to Victoria McLean, who's going to be doing another Q&A session with Croda, which is another of our portfolio businesses. So in terms of an agenda, I'm just going to do a quick sort of recap on what we're trying to do with our strategy from a high level, and then explain why we think sustainable materials are so important. And then I'll hand over to Claire, who'll talk you through some of the companies that we own in the portfolio in this part of the portfolio, and then she'll share some thoughts on outlook as well, on where next. So just as a reminder, the principal focus of our strategy, and many of you will know this already, but just to sort of reiterate it, the principal focus is to invest in companies that are providing products and services that provide solutions to sustainability challenges. So this is, if you like, it's our magnetic north. Our fundamental purpose is to give you, our clients, exposure to the companies that are enabling the transition to a zero carbon and more sustainable economy. This is a slide that we often use in our presentations, and what we've done is we've categorized the broad market, if you like, into three broad categories based on the impacts that the products that they sell have. So on the left-hand side, we have a group of companies that sell products that have a significant negative impact on the environment, in particular, in the companies that you see there. And we think that these companies are at risk of a permanent loss of capital because the market is moving away from those products because of the negative impacts that's associated with them. We then have a rather large category in the middle called transitioning, which represents about 70% of the market. And these are businesses that we all know and love, and we use their products and enjoy their products, but ultimately you can't say that the products have a positive impact on society or the environment. So our focus is exclusively on the companies on the right-hand side, what we call sustainable growth, where every time a company sells another product, you get a cleaner, healthier, safer world. So Aptiv, for example, sell components that go into electric cars. Arcadis, we've already heard from and all the wonderful work that they do. SolarEdge sell components that go back onto the back of solar modules to make them more efficient. And of course, there are many other wonderful businesses in our portfolio selling heat pumps and wind turbines and health therapies, healthy food, energy-efficient products, and so on. So the focus is very much on the product and the impact that that has. And what's important about that is that by selling products, the companies are obviously growing their revenues, which is an important part often of the investment case, but they're also growing their positive impact. So you have those two things absolutely aligned, which is great from an investment point of view. So you can make good investments because of the positive impact that they're delivering. So the transitioning group that I mentioned we don't invest in directly, but they're still very important to us because every time one of these businesses, like Unilever or Microsoft, every time they make a commitment to achieve net zero carbon emissions, it's an early signal that they're going to be buying technologies that will enable them to achieve that objective. And that means changing the way that they plan and design new products. It means changing the kinds of materials that they purchase, how they manufacture, the kind of capital investment that they make, how they heat and cool their buildings, how they run their supply chain, what kind of energy they buy as well. That means, as they do this, that they will increasingly purchase components and services from the kinds of businesses that we invest in. So transitioning businesses aren't directly relevant, but of course they're still very important because they're the ones that need to transition, and we're investing in the companies that are enabling them to transition. And today we're going to be focusing on the materials part of that value chain. So that's just the quick reminder. Now, to talk about sustainable materials, I think you need to take a step back and just look again at where greenhouse gas emissions are generated in the economy today. Overwhelmingly, it's really in the way that we source and use energy. So that's in the electricity system, the fossil fuels that we burn to generate electricity, in the transport system, of course, as well, where oil is still overwhelmingly the main source of power for transport, and also in how we heat our homes. And this has been where the vast majority of the effort so far to reduce greenhouse gas emissions is focused. And rightly so. It's the largest source. It's 55% of the total. It's also the easiest place to decarbonize as well. Wind and solar are now really the cheapest forms of new power generation pretty much anywhere in the world. So this mantra of electrify everything, which you may have heard, really makes sense. If we can electrify things, whether that's cars or heating or industrial heat, then that makes sense. That's the cheapest way to decarbonize. But there is also another 45% which comes from other activities in the economy. 25% comes from food and agriculture and forestry. And then 20% comes from material production, handling, and disposal. So these are the materials that we use in our everyday life, in our cars, in our buildings, in our clothes, in our packaging, and so on. And this is the bit that we're going to be talking about today. So this is our portfolio today in all its glory. We've got 9 different themes, 5 environmental themes and 4 social themes. So 5 environmental themes run from from 12 o'clock to sort of 7 o'clock in blue and green. And then beyond that, we have the social themes in pink and sort of red and yellow, I guess. And the bits that are focused on sustainable materials as a sort of group are these 2 bits at the bottom, these sub-themes. And there are 2 areas. There's one that we call sustainable materials, and that's businesses that make or use materials that have intrinsic characteristics that they are not hazardous, they're not hazardous to human health or the environment, and they don't deplete non-renewable resources. And we've called them sustainable materials. And then there's another segment which focuses on the circular economy, and that includes businesses that are either using or providing infrastructure to recycle or reuse waste materials. And those are the 2 areas that we have in the strategy. So if we take another step back and just look at why are materials such a problem, this is a little graph showing you clothing materials. So material flow for clothing. It comes from 2015, but the data is pretty much the same today. And you can see how overwhelmingly it's a very linear model, and that's the root of the problem with almost all materials actually. In the clothing industry, about 3/4 ends up being landfilled or incinerated. 14% just ends up in the environment, contaminating the natural environment. 13% gets recycled. And this is where, if it gets dumped in the natural environment, this is often where it ends up. This is a picture from just outside Accra in Ghana, and you can see this little cliff here is overwhelmingly composed of clothing waste. It's over 6 feet high, and in the article in Bloomberg, it described it as like geological strata from different fashion eras. And 97% of the clothing industry is based on this very linear model. And of course, what we need to do is to shift to a circular model where we're developing new sustainable materials that avoid problematic and hazardous chemicals, and we increase clothing utilization. Many of you may notice that I'm still sporting my suit from the 2019 M&S brand. Lots of reuse here. No fast fashion for me. But we also need more recycling as well of clothing. And only 3% of the clothing industry is invested with this kind of model at its heart. This brings me to my long-held ambition to talk about fungi briefly in an investment presentation. My old ecology professor, as he used to say, in nature, species diversity in ecosystems is concentrated on detritivores, so the fungi and the other species that break down materials and recycle those materials as nutrients for new growth. And ultimately, our industrial systems do need to reflect this balance between economic activities that create physical products and activities that recycle them. So this is a direction that we ultimately have to move in. And you can also see this problem, actually, in the footprints of downstream sectors, like the fast-moving consumer goods sector. We've got Unilever here in this pie chart showing you the emissions associated, the carbon footprint of Unilever. And there are a couple of things to say about this, which I think are interesting. First of all is how small the Scope 1 and 2 emissions are. It's only 3% of the whole footprint. So that's emissions that are associated with the burning of fossil fuels in Unilever's activities, in their distribution, their logistics, and scope 2, which is the emissions associated with their electricity use. It's only 3%. The vast majority of their footprint actually is associated with the materials that they buy. So 58% of their footprint is in the ingredients and raw materials they buy, and of course packaging as well. 14% of their footprint is in packaging. So nearly 3/4 of their footprint comes from materials. And it's not just consumer goods companies. This is a chart for Land Securities, which is in a real estate business. It's a bit more complex for them. Scope 1 and 2 is a bit bigger. They have big footprints associated with their customers and the construction process. But even here, nearly 20% of their footprint comes from the materials that they're buying. So as these companies commit, and both have, commit to net zero carbon emissions, so they're going to have to increasingly focus on reducing the footprint associated with the materials that they buy. So just before I hand back to Claire, I'll take you back to this chart that I showed you at the beginning. Ellen MacArthur, the Ellen MacArthur Foundation, have done some work looking at steel, cement, plastic, and aluminium. And what they've found is that actually they can reduce 40% of the footprint associated with these materials can be eliminated by 2050 through more circular business models, so more recycling, more reuse of those materials. And the other 60% requires emerging technologies like green hydrogen and carbon capture, but also critically the use of more sustainable materials, including particularly biogenic materials, which of course, as they're produced, they absorb carbon rather than emitting it. So that's is likely to be a particularly important strategy in terms of reducing the carbon footprint of the material supply chain. So thank you very much. I'm now going to hand over to Claire, who'll talk you through some of the companies that we own in the portfolio.
Great, thanks, Seb. So we're now going to spend some time looking at some examples of companies in our portfolio which help to either sell more sustainable alternatives to widely used materials, or which help to accelerate the transition to a more circular economy. And first up is Croda. Now, Croda is a specialty chemicals company which sells thousands of ingredients to thousands of customers. And what we like about Croda is that they are explicitly helping their customers to decarbonize their operations by selling more sustainable raw ingredients. And this is particularly true in their consumer care market, where Croda is specializing in selling bio-based raw ingredients. And these are often used instead of ingredients derived from fossil fuels. So these are much more environmentally friendly. And to give you a sense of scale, in the consumer care market on average, about 10% of ingredients are bio-based. But in Croda's portfolio, that's more like 70%. So that means that sales of Croda's products directly lead to avoided greenhouse gas emissions, which would otherwise have entered the atmosphere. You can see on the left-hand side here our impact forecast for Croda. And by 2030, we estimate that sales of Croda's ingredients could lead to over 1.5 million tonnes of avoided greenhouse gas emissions. And that's about equivalent to 430 wind turbines operating for a full year. But this isn't just good for the planet, it's also good for business, because demand for Croda's sustainable ingredients is so great that it enables them to charge a price premium, which helps their margins. You can see in the consumer care market, which we've just been talking about, Croda achieves an operating margin of about 25%, which is a full 10 percentage points higher than most of their competitors. One type of bio-based ingredient sold by Croda is lanolin, and that's derived from wool grease, like that taken from this happy little sheep. And lanolin is used in a whole number of consumer care products like lipsticks and moisturizers, and is actually one of the first products that Croda was selling when they were established in 1925. It's fair to say that the types of ingredients Croda is developing today are much more scientifically advanced, but you'll hear more about that in the next session with Victoria and Julia. Another example of a company which is helping to sell a more sustainable alternative to a widely used material is Lenzing. Now, Lenzing is actually held in our European fund, although we have historically held it in our global fund as well. And Lenzing sells fibres that are made from dissolved wood pulp, which are used to make clothes. And that's really important because, like with Unilever, about 40% of greenhouse gas emissions in the fashion and apparel supply chain comes from material production. Lenzing's fibres are often used instead of cotton, And although cotton is a natural material, it's also really bad for the environment to grow at scale and make into clothes. That's because of all the chemicals and the pesticides that are used to make cotton, but also because of the greenhouse gas emissions that are generated when you spin, weave, and dye raw cotton. It's also a notoriously thirsty crop. The global water footprint of cotton is about 230 billion cubic meters of water per year, which is about equivalent to 238 bathtubs of water per person per year. Now, we've actually compared the impact of Lenzing's fibres relative to organic cotton, which is a lot better for the environment than most of the non-organic stuff which makes up a lot of the cotton market. But you can see that even using that higher baseline, Lenzing's fibres generate up to 30% less greenhouse gas emissions and use up to 95% less water than organic cotton. And as with Croda, we think this is going to be good for business as well as good for the planet, because we think that demand for Lenzing sustainable fibres should enable them to achieve a price premium to cotton over the long term. You can see that historically they have achieved a price premium to viscose, which is that green line along the bottom. Now, viscose is a bio-based material, but it's typically manufactured much more cheaply than Lenzing's fibres, using a lot more water and energy. But more interestingly, recently, Lenzing has been able to achieve a price premium to cotton as well. Now, the zero-COVID policy in China put a stop to that, but we think that once things normalise, Lenzing should be able to achieve a price premium to cotton over the long term. So what Croda and Lenzing have in common is that they're both selling a more sustainable alternative to a widely used material. And that helps to decarbonise the manufacturing and use phase of a product's life. But as Seb mentioned earlier, it's also important to think about how we can decarbonise the end-of-life phase of a product. So we wanted to share a couple of examples with you as well of companies which are helping to accelerate the transition to a more circular economy. And one example in our portfolios is Smurfit Kappa, which provides sustainable packaging and paper. And this diagram on the left neatly illustrates Smurfit's circular business model. At stage 1, their paper mills process about 7 million tonnes of recovered fibre every year from recycled paper. At stage 2, they turn these into cardboard boxes, which are highly recyclable and biodegradable. At stage 3, Smurfit relies now on recycling infrastructure to collect those boxes back and turn them back into recovered fibres. And about 82% of corrugated paper and cardboard packaging is recycled in Europe, so it's a highly efficient and sustainable material. And then at stage 4, Smurfit combines those recovered fibres with about 25% virgin materials in order to make new cardboard boxes which are just as strong and stable as the first one. And even those virgin fibres are highly sustainable because Smurfit has been certified by the Forest Stewardship Council as a leader in sustainable forestry. And this circular model benefits Smurfit because there's so much demand for sustainable packaging. You can see on the left here the results of a survey conducted by McKinsey, a consultant, and they found that 40% of the companies they spoke to said that sustainability was the #1 most important factor they consider when designing new product packaging. But it's not just companies that want this, it's consumers as well. On the right, you have results from the same survey, but this time speaking to consumers. And you can see that McKinsey found that over 50% of the consumers they spoke to, in almost every country they surveyed, said that they would be willing to pay a price premium in order to get sustainable packaging. And this survey, by the way, was conducted this year, so that's even amid the cost of living crisis. And another example of a company helping to accelerate the transition to a more circular economy, again in our European fund, is Tomra. Tomra is famous for its reverse vending machines, and you can see one being used in Iceland's shop in Fulham in the left-hand side here. These collect plastic bottles and aluminium cans from companies and consumers in return for a small financial deposit. And these reverse vending machines are crucial to the rollout of a type of policy called a deposit return scheme, which is where consumers are charged a little bit extra when they buy a drink, and they only get that money back when the bottle or can makes its way back into one of these reverse vending machines. And you can see on the right just how successful these deposit return schemes have been, practically doubling the PET container collection rate in every EU and US state in which it's been rolled out. And Tomra also sells sorting machines which are used in the plastic recycling process. Recently, Tomra has reported a surge in demand for their machines, and they're entering more and more markets. And that's because there's so much demand from companies for recycled plastic in order to reduce their Scope 3 emissions and meet their climate pledges. That demand has been so great that recently companies have even been willing to pay a price premium for recycled plastic over the virgin stuff just so they can continue to work towards their climate pledges. Then on the other side of that equation, we also own a company called Advanced Drainage Systems in our global fund. Advanced Drainage is actually a stormwater infrastructure company, and we hold it in our water management theme. So it's a great example of a climate adaptation company like the ones Gabrielle spoke about earlier. But we've called Advanced Drainage the stealthy recycler because, somewhat unexpectedly, they actually recycle, or they're the biggest recycler of plastic in North America. And that's because part of Advanced Drainage's impact story relies on them selling plastic stormwater pipes, which were more environmentally friendly than alternatives, which are typically made from concrete and steel. And to do this, Advanced Drainage uses huge quantities of recycled plastic. And they're convinced that over the next decade, we're going to see consistently elevated, or at least very turbulent prices for recycled plastic as companies try to get their hands on it to use it to meet their climate pledges. And so they've responded to that by vertically integrating a huge part of their value chain, plastic recycling. So that hopefully gives you a sense of the type of companies and innovations we're investing in today, but what might the future of innovation in sustainable materials look like? Well, the way we see it, there are two types of innovation that can help to solve this problem. The first is technological innovation, and where we think this is most dearly needed is to figure out how to recycle all those raw materials and metals that are used in zero-carbon industries. And that's because China has come to dominate the supply chains of a lot of those industries, like solar, lithium refining, and EV battery manufacturing. You can see here a map of the world's largest EV battery manufacturers by country, and you can see that China absolutely dwarfs the rest of the world with about 80% of the EV battery manufacturing capacity. So now the West is only just waking up to this, and they're now frantically trying to build their own domestic manufacturing capacity so they can make these technologies themselves. The problem, though, is that a lot of the raw metals on which a lot of these technologies are based aren't actually found in Western countries. So at least part of the solution is going to rely on us being able to recycle the products that are already in the market once they reach the end of their life, so that we can make the best use of the materials that we can already get our hands on. In other words, recycling is quickly becoming a geostrategic necessity. But there are other simpler types of innovation which we can use today to help to meet this problem, and that's innovation around business models. Because as companies and consumers have increasingly embraced the circular economy, we've seen new types of business models pop up which rethink the way we buy and use products. In some cases, like with Bike Club, companies retain ownership of a product, lease it to a customer, and then take it back at the end of the contract so they can lease it to someone else. You might have seen adverts for Bike Club popping up around London. They lease kids' bikes, and basically once your child has outgrown the first bike you leased from them, you give it back to Bike Club, and they give you the next size up. So in that way, Bike Club is closing the product loop and making sure that that bike which your child has outgrown makes its way to a new home instead of being left to go to landfill or left to rust in garages and sheds. In other cases, companies take the product back at the end of its life so that they can recycle it and turn it into a brand new product. Swiss sportswear company On Running is a great example of this because they've recently established a service called Cyclon, which is where customers pay a fixed monthly amount to lease high-end, cutting-edge running trainers. Then once they've run those trainers into the ground, they send them back to On Running, who can recycle them and turn them into a new pair of shoes. Meanwhile, that customer gets sent a brand new model of running shoe. And so the customer gets cutting-edge fashion and sportswear whilst also enabling the transition to a circular economy. So that hopefully gives you a flavour of the types of companies we're investing in, as well as how we're thinking about the future of sustainable materials. Now, Seb and I would love to answer your questions, but I'm going to hand over to Victoria and Julian now for the next session, and we'll be back at the end of that for some Q&A. Thank you.